You can't rely on oil and gas news to determine what's going to happen with oil prices. If you were listening to the 2015 news, you would read articles like this that says the days of $100 oil prices may be gone forever. And they have this picture of this sheik here because these guys know about oil, right? They know everything. Listen, this is one of many articles that were being spread throughout the universe saying, hey, we'll never see $100 oil again. Okay. And obviously that was far from the truth. Here we are at $100-something a barrel of oil. And so he's obviously wrong, but everybody read it. Everybody clicked on it. And so that same thing that is happening in the news back in 2015 is happening today. There's new articles out saying, hey, oil prices are dropping and demand is dropping and, oh, the economy is going to fall apart. Man, we've been hearing that for the last 3 years now. And here we are. Oil demand is growing. Oil production is declining. Oil prices are going up, wars and everything else. So I'm going to talk about shale, how it's on the decline, U.S. shale, how that is going to greatly affect oil prices. The wars in the Middle East, the wars in Ukraine, that is going to have a huge impact on oil. And I'm also going to talk about how OPEC continues to manipulate oil and gas prices, okay? Right now, WTI crude is trading at $96.76. Brent crude is $101 per barrel. Natural gas has really made a huge comeback at $6.30 per MCF. Here we go. $150 oil is still a distinct possibility. I agree 100%. Okay. The most commonly cited bullish factors were OPEC's unwillingness to boost production by more than originally agreed, while demand for oil continued strong. Now, all the news appears to be on the war in Ukraine, and the main bullish factor for oil is the expected continued decline Russian oil exports. The country is the largest exporter of crude oil and oil products and a big supplier to the European Union, which explains the EU's reluctance to directly target its energy industry. Yet pressure is growing on Brussels to do just that. And with coal already on the sanction list, it's probably only a matter of time before oil becomes a target too. When this happens, Brent may well top $120 and stay there. Now, if you look at coal prices, okay? And so just recently we went from 136.99 per a ton, and it skyrocketed to $424 per ton. Okay. And so they are sanctioning coal and not buying coal from Russia. And that caused coal prices to skyrocket. Well, what do you think is going to happen if the EU restricts oil? Okay. Now, in the meantime, the United States has publicly stated it had banned all Russian oil and fuel imports. But in fact, the ban is only coming into effect on April 22nd. And in the meantime, the U.S. is stocking up on Russian oil and products. So right now, see, listen, there was a lot of talk about banning Russian oil, and all of a sudden oil prices skyrocketed, okay? And then they started to drop. Why? Because we have not seen the effect of the sanctions yet, because we're buying cheap Russian oil right now. We're stocking up. And so then the stocks for oil start to increase, and then the EIA produces that information, and then oil prices drop, okay? But here's the deal. This is only going to happen for a short time, okay? Now, while all this was happening, oil prices dipped after the announcement of the U.S. SPR release, with the West Texas Intermediate even falling below $100 per barrel. Okay. Yet the dip was only a brief one, and prices are once again above $100 as fundamentals reassert themselves after the initial market reaction to the Biden administration's decision for the reserve release. Now, prices are likely to continue climbing, just like they did after the first Biden SPR release last year, again in an attempt to put a lid on retail fuel prices. At the time, prices reacted with a dip immediately after the news and then rebounded as emotions gave way to facts. I mean, it's just unbelievable that the world's largest economy could be so ignorant if they would just wait. If news came out, if they would just wait to see what happened, it wouldn't be this knee-jerk reaction. It's just unbelievable how the markets react to news. Now, the release is a massive In comparison to the first one, it would amount to 1 million barrels a day over a period of 6 months. Theoretically, this would cover a third of the Russian oil export dip as predicted by the IEA. In practice, traders have probably already started to worry about how the administration will replenish the SPR after the release and what that would do to oil prices. So here's the deal. We announced the release of 1 million barrels a day from the Strategic Petroleum Reserve of the United States. Okay. And then on top of that, we're buying cheap Russian oil right now at a rate that we've never have before because we're taking advantage of the situation. Okay. And then, of course, the oil stocks are increasing. So all that data is going out to the world. And what does that do to oil prices? It causes them to drop. But once we actually cut off Russian oil, and we have to deal with the fact that all of this oil that we're using is coming from our savings, and we have to replenish that. Okay. And so I'm going to be discussing about the Shale decline, how we will never be able to replenish that oil. Meanwhile, in Europe, coal prices jumped following the news of a coal import ban on Russia, with European Commission President, we will impose an import ban on coal from Russia worth 4 billion euros per year. This will cut another important revenue source for Russia. So you saw how doing so caused coal prices to skyrocket. Okay. And so they have yet to do that to oil. That's the next step. What does this mean for oil? Based on what we saw with gas and coal prices in Europe last year, the prices of fossil fuels are linked. When one becomes prohibitively expensive, demand for the others rises. That's why coal prices soared last year. In fact, utilities turned from gas to coal in search of more affordable source of energy. Now I'm going to talk about OPEC. And so this is a map of what OPEC is. Okay, so OPEC is a conglomerate of oil producing countries that came together, and they will agree on the amount of oil they will produce. So it consists of Algeria, Libya, Nigeria, Gabon, Congo, Angola, Ecuador, Venezuela, Iraq, Iran, Saudi Arabia, UAE. OPEC and OPEC Plus, which is all those countries I had mentioned before, plus Russia, how they manipulate oil prices. And so back on March 8th, 2020, Saudi Arabia initiated a price war on oil with Russia. And so they pumped as much oil as they could, okay? And they competed to see who could last longer. And Saudi Arabia reduced its oil price down to 25, and they flooded the market, causing oil prices to crash. So I said on March 8th, correct? And so if we look at March, oil prices dropped down to $20 per a barrel, okay, when they crashed. And then later, after the oil price war ended, OPEC and its allies announced late Sunday that they have agreed to lower their crude oil production by a total of 9.7 million barrels a day in May. Okay, so this was a result of a oil price war. Then in May, here we are, May 1st, they decided to cut back 9 million barrels a day. Now, this is during the COVID pandemic. This is the worst demand for oil has ever been, well, in the last 10 years. And so if we look here, oil prices stabilize and they stay above $46 a barrel, and they continue to rise, okay? And if you look at from here, this is when oil prices crashed due to the oil price war between Saudi Arabia and Russia. And then they reduced almost 10 million barrels a day on the market, and look where prices go. We hit over $100 a barrel. So OPEC has a tremendous amount of influence, and Russia, on oil prices. OPEC sticks to modest oil output hike as U.S. considers unprecedented release of reserves. Okay. Now here's the deal. Biden was trying to get OPEC Plus to agree to increasing their oil output, but they stay consistent. Even though that we don't have enough oil, they continue to slowly increase it by 400,000 barrels a day per a month. Okay. And so they are steadily increased. So they reduced it by 10 million barrels a day, and they're steadily adding that to the market as oil oil demand increases. Okay, so if you look at oil demand, all right, so right here, I downloaded this from OPEC. Okay, I think OPEC has the most accurate spreadsheets when it comes to oil demand and production. Okay. So this is the Americas. Okay. So the Americas in 2018 produced the demand was 25 million barrels a day. All right. And they're saying of which the US, so 20 million of that 25 million in the Americas is the US. Okay. So we had the biggest demand out of the Americas. Europe was 14 million, Asia Pacific, 8 million, and then China. And so the Americas, Europe, and Asia Pacific, those are the OECD countries. So that accounts for 47 million. Now that you got China, you got India, other Asia, Latin America, Middle East, Africa, Russia, other Eurasia, other Europe, okay, for a total of 51 million for non-OECD countries, for a total of 99.2 million. And so in 2018, our demand was 99.21 million. 2019, our demand was 100 million. And 2020, because of COVID pandemic, we dropped down to 91 million. That's a far cry from where they were saying it was going to drop down to 60 million barrel a day demand. Now, if you look here, first quarter of 21, it was 93.84 and then grew to 100 million barrel a day demand, the highest this world has ever seen. If you look here in first quarter of 2022, all right, demand at 99.14 million. Second quarter of 2022, they are expecting 99.78 million, and quarter three will be an all-time record. They're expecting to see 101.36 million barrel a day demand, and quarter four, 103.24. Now, OPEC, this is what they believe. So demand is continuing to grow. All right. And so most of what you hear in the news regarding oil and gas demand is far from, well, it's not far from the truth, but it could be very wrong, especially during the pandemic. So don't believe what you read in the news. Demand is on the rise. But the problem is the media believes what they are hearing in many aspects. But the thing is, they only report what they hear. They reported that COVID-19 was going to destroy demand. Well, that didn't happen. They also believe that the trillions of dollars they're spending with the new administration, with the Green New Deal, they also said by this time our demand would be around 80 million barrel a day demand. Well, that isn't true. That simply just is far from the truth. I mean, to be off by 20 million barrels a day, that's big league. I mean, you don't just say that and parakeet that across every news network and then not come back and say, hey, remember that time we said, during COVID, oil demand was going to drop down to 67 million barrels a day. Remember when we said that the Biden administration was going to cause the demand for oil to decline? Well, none of that happened, guys. Sorry, we're wrong. They're never going to do that. And that's what's happening today. All right, so I want to talk about shale oil and gas. If you look here, this is a great article. And so last year, shale companies focused on paying down debt and returning cash to shareholders through increased dividends and share buybacks. Companies such as Devon Energy and ConocoPhillips began offering variable dividends, boosting cash payouts during periods of high profitability. Capital discipline helped the sector to generate enormous cash flow. 20 of the top shale producers in the United States generated nearly $36 billion in free cash flow in the first 3 quarters of 2021. So it doesn't make any sense to spend all of their cash on new development when they already have a lot of oil production and they could just take in the free cash flow from selling their oil at $100 a barrel. Okay. And so now they get past that income, that extra cash to the investors. Underpinning this profitability, however, is an unsustainable level of investment. Last year, most shale companies reinvested less than 50% of their cash flow in new drilling as the industry downshifted into maintenance capex mode, but initial production rates at wells usually dropped off quickly. So companies need to drill continuously to sustain output. They can only pull back on investment for so long without sacrificing future production levels and cash generation. So that's what we're seeing right now. We're sacrificing future production levels because they're not spending enough money on developing oil and gas wells. And initial production rates, wells usually drop off quickly. Okay, I'm going to talk more about this later. All right, so if you look here, these are all the major oil companies: ExxonMobil, Chevron, ConocoPhillips, and so on and so forth. Their average spending reinvestment ratio of the money that they bring in is only 38%. Those numbers are way too low to maintain our U.S. oil production, let alone increase it. All right. Management teams are determined to stay disciplined this year. Most companies will prioritize payouts to shareholders and debt reductions. Companies insist they will take a more disciplined approach to new capital expenditures. For example, running an additional rig or two in their highest margin areas to generate more cash flow. Consolidation in the shale patch also means that more conservative management teams control a larger share of output. Okay. And so bottom line, shale companies are being disciplined. They're spending less money and they're taking advantage of the situation and just taking in the profits. Okay. This was a great little article that I saw here. Ultimately, the technology can't overcome core characteristics of shale. Steep decline rates, wells decline between 75 to 90% in the first 3 years, and field declines without new drilling typically range from 25 to 50% per year. And variable reservoir quality with sweet spots or core areas containing the highest quality reservoir rock, typically comprising 20% or less of overall play area. Tight oil and shale gas producers have focused their efforts and technological improvements on targeting these sweet spots. And in many plays, we are already witnessing the point of diminishing returns, but the EIA, Energy Information Administration, that is funded by the USA, is counting on and asking the American people to bank on technological miracles overcoming physical limits. A sound energy policy, however, should be based on reality. Okay. And so bottom line, what they're saying is here, listen, guys, there's a massive decline in shale. The sweet spots are almost gone. In fact, most of them are gone. A sweet spot simply means a shale well and a sweet spot, which accounts for the 20% of the field has the best location. The other 80% is okay. Okay. Well, most of that 20% is gone. And so these other wells surrounding the 20% of the sweet spot of the better locations already been developed, and the upside is much lower. And they decline faster and they produce less. Okay. And so but the EIA is counting on and asking the American people to bank on technological miracles overcoming physical limits. So the same thing that they're doing with green technology, they're believing that a technological miracle for green tech to replace fossil fuels. They're also believing that the shale companies are going to come up with something amazing as well to help with the decline. That ain't happening. Some smart shale guy sat down with some guy at EIA or the government and overpromised and underdelivered. I mean, that seems to be happening all across the board in green tech as well. Now, why U.S. shale production declines are higher than you might think, okay? Unconventional production dominates. Nearly 2/3 of U.S. oil production is from the unconventional plays listed above. The remainder group in the Central Basin Platform also likely to include some amounts of unconventional production, so that total is probably higher. Okay. Now, what I want to talk about, explain, is the decline of shale oil and gas and why we cannot rely on shale, okay, which is, according to this, 75% of U.S. oil production comes from shale. This is why this is something you need to pay attention to. So first year expected declines are high in unconventional plays. Even though the older wells in each play produce at a lower declines than the more recent wells, their first year decline rates for the play remain high. While it is true that the wells decline more slowly as they age, their high initial declines mean that by the time they reach lower decline rates, they are producing at relatively low rates that contribute little to flattering the decline of the entire play. In our analysis, the first year declines of the unconventional plays are in the 40 to 50% range, while the others average around 15% annually. Okay. And so that means we got to drill a lot of shale oil in order just to maintain the amount of production we have today. In our analysis, the total U.S. oil-based production decline is 34%, which would result in 4.2 million barrel a day reduction after 1 year in the absence of additional drilling. Listen, if we stop drilling oil, our U.S. oil production would drop down to George Bush levels, back when we were producing about 5-6 million barrels a day. Okay. And so we just need to drill just to maintain our current output, but we're not even doing that. Okay. And so I want to look here. So this is so Permian Basin decline rates. Permian Basin is in Texas. It's one of the biggest shale. It accounts for a third of U.S. oil supply. It's an oil reservoir in Texas, okay, called the Permian Basin. This is according to a new report from IHS Markit, which found that base decline rates of more than 150,000 producing wells in the Permian rose from 34% in 2018 to 40% this year. These figures represent a contraction of 1.5 million barrel a day. So the decline rates of shale wells are increasing. All right. Base decline is the volume that oil and gas producers need to add from new wells just to stay where they are. It is the speed of the treadmill, said Raul, vice president of the unconventional oil and gas unit at IHS. Because of the large increases of recent years, the base decline production rate for the Permian Basin has increased dramatically, and we expect those declines to continue to accelerate. As a result, it is going to be challenging, especially for some companies with cash constraints, just to keep production flat. Guys, do you not see the problem here? I mean, the EIA, the Energy Information Administration, the guys that the whole world relies on, is saying, hey, don't worry, Shell's going to come save the day, and we're going to fix everything with green tech. Look, none of this is going to happen. And Russia's on the chopping block for 3 million barrels a day. Imagine when that happens. So here's the deal. Here's my whole point. Shale oil and gas, it accounts for 75% of the oil in the U.S., and it's declining at a rapid rate in between capital discipline, banks not lending for oil and gas, shale on the decline. We're in for some very rocky times. There's going to be an oil shortage, and that's why Biden is taking oil from the strategic petroleum reserves, because we don't have enough oil. And OPEC continues to not hear the cry of the world as they are resilient, and they continue to be disciplined in adding oil to the markets versus flooding it like Biden wants them to. Now, there's a reason why U.S. shale oil has maintained the numbers. And so, Sean, if the decline is so rapid, then why hasn't it dropped very quickly? Well, here's why. Okay. There's this thing called DUC, drilled uncompleted wells. Okay. So there was thousands of wells that were drilled in 2019, 2020 that did not get completed. So you could drill a well in the ground, but if you don't complete the well, the oil will not flow. Well, they just simply, they're starting to complete these wells. All right. So they're not drilling for oil, but they're completing wells. Well, we have thousands of DUCs, thousands of drilled uncompleted wells. Okay. The United States estimated inventory of drilled but uncompleted wells in key oil and gas basins declined 27%. So the amount of wells that have not been completed yet have dropped 27%. From June 2020 through May of 2021, the U.S. Energy Information Administration reported Monday. According to EIA's most recently monthly drilling productivity report, The U.S. DUC inventory for May 2021 was approximately 6,500 wells in 7 major tight oil and shale natural gas basins, down from June 2020 peak of 8,800. The U.S. Department of Energy statistical arm added that 2,600 DUCs, nearly 40% of the total, are in the Permian Basin of West Texas. Okay, so we used to have 8,800 uncompleted wells. Okay, and so it has dropped tremendously. Once we put all the DUCs online, we are not going to be able to stabilize current oil production, and we're going to start seeing a major reduction of oil of the shale because of the shale decline. Okay, and we're not spending enough money on developing oil. So what you're seeing right now is temporary. Okay, and so let's look here. The other thing I want to talk about is the wild card that nobody was expecting. I mean, Russia went into Europe, oil prices went to $100 a barrel overnight. Okay, now if you think about why are there so many bombs being dropped in the Middle East and Europe, it's quite simple. They don't respect our president. I mean, the poor pullout of Afghanistan said to the world, we are weak. Okay, and so leadership has a lot to do with what's going on, whether you believe it or not. By late 2020, the conflict in Yemen was heading toward a stalemate, with the coalition forces being unable to end the Houthi control over the capital city, Sana'a. As a result, the UAE announced it would start disengaging from the war. However, in late 2021, the Houthis moved toward the oil-rich governorate of Marib to prevent the group from controlling oil rents. The UAE renewed its involvement in the conflict by backing the Giants Brigade, a local Sunni militia, to fight against Houthi advancements. So the war with Houthi versus Yemen, that conflict has continued to grow. Okay, and it's only getting worse. And so the Houthi rebels are the ones that are dropping bombs on key oil facilities in Yemen, in Saudi Arabia, in different parts of the Middle East. Okay, and that greatly affects oil prices. Attacks on Saudi oil infrastructure increases. And so there's a lot of news talking about that, but there's also a lot of news today. Oil prices set for weekly fall on stockpile release. Remember what I said about stockpiles increasing because we're buying up cheap Russian oil, and we're also releasing 1 million barrels a day from the Strategic Petroleum Reserve. But listen, once we stop buying Russian oil, and once the EU stops buying Russian oil, I mean, get ready for high oil prices. And so oil settles lower on doubts about Russian oil sanctions. Listen, the doubts about Russian sanctions, it's because oil prices skyrocketed because we said we're going to sanction Russian oil, but then we didn't do it. Okay, we're prolonging that because the EU, Europe can't do it without the oil. Neither can America. So we're buying up as much oil as we can for now, and then we're going to cut these guys off. Okay. And so most of listen, the news that gets here, it's based on the Google algorithm. All right. The more times it gets clicked, the more times you read it, this is what is chosen here. It's based on statistics. Okay. And it's also, listen, the media, they protect old Joe. They don't want to make his Green New Deal look stupid. I mean, they're pushing an agenda. They push the COVID thing. They push the green thing. It's all ridiculous. And they said oil prices would never come back to $100 oil. I'm not going to get into this article here, but it says, is today's energy shortage worse than the 1970s oil crisis? I'll be talking about that later down the road. But here's the deal. We're going to end it with this beautiful picture of this Saudi guy that said, we'll never see $100 oil again. I want you guys to remember that most of what you read most of it is garbage, okay? Most of it is clickbait. Most of it's not even real. Most of it's not even based on fundamentals. It's an article that some young, columnist or whatever is writing just to get your attention. But here's the deal. once we cut off Russia in oil imports in the EU and America, and shale is on the decline. It's declining even faster now because all the sweet spots have been taken, okay, and they're developing in lesser quality basins, oil and gas formations. 75% of U.S. oil is shale. When we were producing 6 million barrels a day under Bush, oil prices went over $140 a barrel, okay? And if you look at the wars, they're increasing. Wars are increasing. And let's say by some miracle, hey, the Green New Deal, it works. Okay, we're reducing our dependence on oil. Okay, although oil demand is increasing. Well, let's say that happens. And let's say we go through a recession. Well, OPEC has been manipulating oil for years. What do you think they're going to do? They're going to reduce the amount of oil. I mean, during the pandemic, oil prices climbed. Why? Because they reduced the amount of oil on the market by 10 million barrels a day. It makes more sense for them to produce less oil and sell it at a higher rate versus producing more oil at a cheaper price. It costs more money to do that. So if they make more money reducing the amount of oil in the market, why wouldn't they do that? Less electricity, less cost, less maintenance. And also they're not getting rid of their oil. I mean, they wanted America to get rid of our oil. Because listen, nobody's making oil anymore. Whatever's under the ground, that's it. Okay. At some point we will run out of oil. And so it was a smart move for the OPEC, Saudi Arabia, to not answer the plea of Biden and get us to start getting rid of our oil savings from the strategic petroleum reserve. Very smart move on their part. And here's the deal. If oil prices drop, OPEC will manipulate. Russia will drop a bomb. Houthis will drop a bomb. They can afford to not to have oil prices at $100 a barrel. All right, guys, I'm Sean Pruitt, president of Kingdom Exploration. If you like this channel, please subscribe. And if you're interested in investing in oil and gas wells, I've got a great project for you. Give me a call. I'd love to chat with you. Look in my description below. Thanks.